In part one of analyzing business transactions with T accounts, we learned how accountants use T accounts to organize transaction data and better understand how debits and credits affect individual accounts. We also practiced analyzing several business transactions for Eli's consulting services. Now, if T accounts feel a little unfamiliar, don't worry. Learning debits and credits takes practice. The good news is that the more transactions you analyze, the easier the process becomes. In part two, we'll now continue building on those skills by analyzing additional business transactions for Eli's consulting that are common for service businesses. As we work through these examples, you'll continue strengthening your understanding of how we write transactions into T accounts and how accountants keep financial records organized and accurate. As a reminder, I recommend that you follow this approach to identifying debits and credits, where in step one, you identify what accounts increased or decreased, followed by step two, where you classify the accounts that you identified in step one by account type, and step three, where you use the dealer mnemonic to find the debits and credits. Let's look at transactions 7 to 12 for Eli's consulting and apply this process to the analysis of business transactions with the use of T accounts. In the seventh transaction for Eli's consulting services, the business earned $36,000 in revenue from clients who paid cash for bookkeeping, accounting, and consulting services. When we analyzed this transaction using the accounting equation, we said that the business's cash increased because the business now has more cash. Cash is an asset, and according to the dealer mnemonic, assets increase with debits. Since cash increased, we need to debit cash. What about the second part? Remember that every transaction has at least two parts, at least one debit and one credit. When we analyzed this transaction previously, we said that fees income increased. Fees income is a revenue account, and we can see in the dealer mnemonic that revenue accounts increase with credits. The revenue increased, so we credit the account fees income. So debit cash and credit fees income. Next, we find the T account for cash and write the transaction number G and the amount of $36,000 into the debit column of the cash account because we determined in step 3 that we would debit cash. The amount for the revenue account fees income increased as well, and we learned in step 3 that revenue accounts increase with credits on the right side of the T account. We create a T account for fees income and write the transaction number G and the amount of $36,000 into the credit column of the fees income T account. That completes the analysis of our 7th business transaction with the help of T accounts, but let's practice some more. In the 8th transaction for Eli's consulting services, the business earned $11,000 in revenue from various charge account clients. When we analyzed this transaction using the accounting equation, we said that the business's customers now owed money to the business. We call that an accounts receivable because these are accounts that the business will receive money from in the near future. Accounts receivable is an asset, and assets increase with debits. Fees income also increased. Fees income is a revenue account, and revenue accounts increase with credits. So we debit accounts receivable and we credit fees income. Next, we enter the transaction into the T accounts, and we create a new T account for accounts receivable with debits on the left and credits on the right, and write the transaction ID H and the amount of $11,000 into the debit column of the cash account because we determined in step 3 that we would debit accounts receivable. The amount for revenue, the revenue account fees income increased as well. And then we learned in step 3 that revenue accounts increase with credits on the right side of the T account. We find the T account for fees income, write the transaction ID H and the amount of $11,000 into the credit column of the fees income fee account. Let's move on to transaction number 9. In the 9th transaction, Eli's Consulting Services received $6,000 on account from clients who had owed money for services previously billed. We previously analyzed this transaction using the accounting equation and said that the business's cash increased. Cash is an asset, and when assets increase, we debit the account. So we debit cash for $6,000. Accounts receivable decreased because the clients paid Eli's Consulting and reduced their debt with the company. Accounts receivable are an asset account, and assets increase with debits and decrease with credits. Since accounts receivable decreased, we credit accounts receivable for $6,000. We'll now write this transaction into the T accounts. We find the T account for cash, write the transaction ID of I and $6,000 into the debit column of the cash account because we determined in step 3 that we would debit cash. The amount for the accounts receivable account decreased. We learned in step 3 that asset accounts decrease with credits on the right side of the T account. We find the T account for accounts receivable and write the transaction ID I and the amount of $6,000 into the credit column of the accounts receivable T account. All right. In the 10th transaction, Eli's Consulting Services paid $8,000 in salaries for the accounting clerk and Sergio Sanchez. In this transaction, salaries expense increased, and the dealer and salaries expenses are an expense. And the dealer mnemonic tells us that expenses increase with debits. So that means that we need to debit salaries expenses for $8,000. For the second part of this transaction, we previously determined that the cash account decreased. Cash is an asset, and assets decrease with credits. So in this case, cash decreased, so we have to credit cash for $8,000. We write this transaction into the T accounts. We'll set up a new T account for salaries expense and write the transaction ID J and the amount of $8,000 into the debit column of the salaries expense account. Next, we'll find the cash account and write the transaction ID J and the amount of $8,000 into the credit column of the T account. In the 11th transaction, Eli's Consulting issued a check for $650 to pay the utility expenses. We previously analyzed this transaction using the accounting equation and said that the business now has more utility expenses. Utility expenses are classified as expenses, and the dealer graph tells us that expenses increase with debits. The business expenses increase, so that means we need to debit utility expenses for $650. The cash account decreased. Cash is an asset, and assets, according to the dealer mnemonic, increase with debits and decrease with credits. And in this case, cash decreased, so we have to credit cash for $650. We'll now write this transaction to the T accounts. We'll set up a new T account for utility expenses, write the transaction ID K and the amount of $650 into the debit column of the utility expense account. Next, we'll find the T account for cash, write the transaction ID K and the amount of $650 into the credit column of the cash T account. The last transaction, number 12, is up next. In the 12th transaction, Trade and Eli withdrew $5,000 in cash for personal expenses. Just as a reminder, withdrawals are funds taken from the business by the owner for personal use. These payments are not associated with the business, but rather rather a return of the investment that Trade and Eli made into the business. Monies given to the owner are classified as drawings, and drawings, according to the dealer mnemonic, increase with debits. That is why we're debiting the drawing account for $5,000. The amount for the cash account decreased, and cash is an asset, and assets decrease with credits. That is why we credit the cash account for $5,000. Then we find the T account for Trade and Eli drawing and write the transaction ID L and the amount of $5,000 into the debit column of the T account, and then find the T account for cash and write the transaction ID L and the amount of $5,000 into the credit column of the cash T account. Now that we entered the last transaction into the T accounts, we can sort the T accounts into the assets, liabilities, and owner's equity categories. And we also need to figure out whether we're still in balance. That is why the next step is to calculate the totals for each column of the T accounts and calculate the balance. Calculating the totals for each column is called footing. For the cash account, we have total debits of $125,000 and total credits of $13,650 and a final debit balance of $111,350 after we subtract the credits from the debits. If there is only one debit or one credit, like in the accounts receivable account, you don't need to foot the columns, but rather just calculate the balance. We still don't quite know yet if we are still in balance or if we perhaps have forgotten one side of a transaction. That is why our next step is to prepare a trial balance. The trial balance is a listing of all T accounts with their debit amounts in one column and the credit amounts in another column. For Eli's Consulting, the trial balance has a header section that shows us the name, the title of the report, and the time period. Below that is a column for the account name and a column for the debit balance amount and one for the credit balance amount. At the bottom of the report is the total, and this is very important. The total debits must equal the total credits, or there's a mistake somewhere. That is why accountants use the trial balance to verify the accuracy and completeness of the accounting entries. If the total debits do not equal the total credits, which may happen in manual accounting, which is what we're doing here, we need to go back and fix our entries. Now, in a computerized accounting system, the total debits always equal the total credits in the trial balance because that is checked automatically as you load or enter journal entries into the system. You wouldn't be able to record a transaction that doesn't balance. But as we're learning about manual accounting, it will happen to you all quite frequently because you'll forget to record one side of the entry or transpose a number. My advice is go through this process slowly and double check your work as you go. Nonetheless, you will make mistakes because that is just part of the learning process. So here are a few tips for finding what transactions you might have recorded incorrectly. Now, if the difference between debits and credits can be divided by 9, there is a transposition error. Like, for instance, you wrote 45 instead of 54, or you entered 3,500 instead of 5,300. The difference between 5,300 and 3,500 is 1,800, which is divisible by 9, and that would therefore be a transposition error. Now, a slide is an error that occurs when the decimal point is misplaced. So you've entered one side as $375 and the other one as $3,750. Those are the two typical errors that you might find. Other errors would be, for instance, you recorded a debit, but you forgot to record the credit. That's typical as well. That is why after the trial balance has been prepared, we double check that the total debits equal the total credits. For our trial balance here, the total debits of $150,500 equal the total credits of $150,500, and that confirms that all transactions are in balance. So don't forget that important step. Double check that your debits equal your credits. Now, this is important. The trial balance doesn't tell you if you've forgotten one or more transactions in their entirety. And if you're using accounting software, you would run a system report that is called trial balance. In Chapter 3 of College Accounting, you were introduced to another important tool accountants use to analyze business transactions, the T account. You also learned how the concepts of debits and credits are used to record changes in accounts, and how the trial balance helps accountants verify that the accounting records remain in balance. Now, at first, debits, credits, and T accounts may seem unfamiliar or even a little confusing, and that's completely normal. Like many accounting concepts, these skills become much easier with practice and repetition. The more transactions you analyze, the more confident and comfortable you will become using T accounts to understand how business activities affect the accounting records. These concepts form an important foundation for future accounting topics, and we will continue building on them throughout the course.